This chapter discusses the term financial management decision. This chapter focuses on the evaluation of working capital. We can determine the working capital position of a company by analyze accounts receivables, accounts payables, and inventory ratios. Evaluate policies for working capital management, including its individual elements. Discuss methods for financing working capital. Analyze the short-term cash position of a company. Discuss measures to manage the short-term cash position of a company. And discuss dividend sustainability. The efficient operation of any business requires that management should be constantly looking forward and planning ahead. This chapter discusses the need to manage working capital, which requires constant attention, before the next chapter looks at the issues associated with longer-term forecasting and budgeting. Current assets are assets that are either cash or will be converted into cash in the normal course of business and consist of short-term investments including cash, trade receivables, and inventory. Current liabilities are liabilities that are due for payment within 1 year. Typical examples would be short-term loans, overdrafts, and trade payable, all of which provide funds to finance current assets. Working capital management is an important aspect of a company's financing activities. Companies need to select the optimal level of current assets and the optimal combination of long-term and short-term funds to finance those assets. Insufficient liquidity could lead to deterioration of credit rating, forced sale of assets, bankruptcy, or liquidation. During a crisis, effective working capital management becomes crucial. Strategies include tightening credit policies, renegotiating payment terms with suppliers, and closely monitoring cash flow. Prompt, decisive actions can mitigate risks and maintain operational stability under adverse conditions. You need to know the two ratios previously learned, which are current ratio and quick ratio. Current ratio is the current asset over current liabilities, and current ratio is the current asset minus inventory divided by current liabilities. 3 other accounting ratios are also relevant. Each measures the time taken to dispose of or settle an element of working capital. The 3 ratios are inventory turnover period, trade receivables turnover period, and trade payable turnover period. Many businesses struggle with working capital due to common mistakes like overestimating sales, underestimating expenses, or neglecting inventory levels. These errors can lead to cash flow issues, making it vital to monitor and adjust practices regularly. Next section is to learn on working capital cycle. The working capital cycle, or net operating cycle, of the firm is the time from payment to suppliers for the materials to receiving cash from the SAT of goods produced from the materials. Working capital cycle is equivalent to inventory turnover period plus the trade receivables turnover period minus the trade payable turnover period. Shorter operating cycles enable the company to generate cash faster and reduce the need for liquid assets and external financing. Working capital thus creates a dilemma for management because 1. Insufficient working capital creates the risk of insolvency, and 2. Excessive working capital is also harmful because current assets are unproductive while they are waiting for sale or for settlement. A company's liquidity position, as represented by cash, trade receivables, marketable securities, and inventories, could affect its ability to borrow. To maintain liquidity, companies rely on cash balances, short-term funds including trade credit and short-term investments, and cash flow management, which determines the collection and payment processes. The key to successfully managing working capital is to keep the inventory turnover and trade receivables turnover as rapid as possible while delaying payment so that the trade payable turnover is as long as possible. Next is managing inventory. Inventories can take the form of raw materials, work in progress, and/or finished goods for resale. Companies hold inventories of raw material and work in progress to support the production process and finished goods to serve customer needs. Running out of inventory can disrupt production or lead to lost sales. There are other benefits to holding each of the forms of inventories. 1. Holding supplies enables a company to buy them in larger quantities and so take advantage of bulk discounts. 2. Enables a company to buy them in larger quantities and so take advantage of bulk discounts. 3. Holding stocks of finished goods, in addition to improving the ability to meet customer demand, may allow the company to benefit from economies of scale of producing its product in larger production runs. Other methods, such as just-in-time (JIT), enable firms to minimize the level of inventory needed to support sales. For example, the just-in-time (JIT) approach is used in car making and other businesses. It involves parts arriving and going straight onto the production line for immediate use. A car factory might have a continuous flow of parts and materials in constant motion, with items arriving just as they are needed to complete the next phase of production and completed cars being driven out of the factory for immediate dispatch to customers. Managing trade receivable. The same need to balance different considerations also applies to the management of trade receivables. Businesses generally give their customers 1 month to settle their debts, and many customers take a little longer than that to pay because there are unlikely to be any adverse consequences for doing so. On the other hand, the firm has to consider the trade-off between increasing sales and non-collectible accounts in allowing trade credit to its customers. Managing trade payables. Managing trade payables is the opposite of managing trade receivables. Taking longer to pay will delay the outflow of cash, reduce the need to pay interest on overdrafts or short-term borrowing, and shorten the working capital cycle. Taking longer to pay will delay the outflow of cash, reduce the need to pay interest on overdrafts or short-term borrowing, and shorten the working capital cycle. Taking an excessive time to pay may affect the company's creditworthiness and so threaten the credit facilities offered by suppliers. There are credit rating agencies that offer reports on business credit histories. A business that has been reported for making late payments or, worse, defaulting altogether may find it difficult to obtain trade credit in the future. There are also trade discount, where a company may have the opportunity to delay payment but is offered a discount for early payment. Next is main sources of short-term finance. Bank loans or money market sources are the main sources of short-term finance for a company. Company can use 1. Single bank loan. 2. Line of credit. 3. Secured lending. How to calculate the financing costs. Companies need to compare the effective cost of various types of short-term finance and select the most cost-effective method of borrowing. The effective cost of various types of borrowing can generally be calculated by adding the interest and any other expenses that the type of borrowing involves and dividing the result by the total amount that the borrower receives. Financing cost is equal to interest cost plus fee divided by usable fund. Next is managing cash flows. The company treasurer is responsible for managing cash balances and must monitor cash flows on a real-time basis in order to do so. Companies must balance their cash inflows and outflows, and the key to managing a business liquidity is to predict future cash flows with a view to predicting problems. The biggest concern would be an excessive deficit. The company's risk tolerance and liquidity position will determine the type of investment it selects. Finally, cash, dividends, and dividend sustainability. The primary function of any business is to generate wealth for its owners. That wealth is generally reflected in the form of a stream of cash payments. Simpler business forms such as sole traders and partnerships generally make these payments directly from the business bank account to the owner or owners. If the business has been incorporated as a limited company, then it will generally pay its owners dividends. The payment of dividends is generally restricted by 2 factors, i.e. 1. The law generally forbids the payment of dividends that will create a deficit on retained earnings. 2. It is also necessary to have sufficient cash available to pay the dividend.